Hello and welcome to LiveSquawk's Financial Markets podcast on Friday, the 10th of April 2026. Every week, myself and guests break down the key stories of the week gone and look at the implications for the markets. We'll also preview the week ahead, providing you a heads up as to what you should be looking out for. This episode, I'm joined by regulars and long-time traders and analysts and friends of the show, Ryan Littlestone of Forex Analytix and Michael Brown, market analyst at Pepperstone. They're spread betting, CFD and Forex trading broker. I'll bring you both in shortly, but before I do, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We are not licensed financial advisors, and none of the information shared should be considered as financial, investment or trading advice. Please conduct your own research, consider your financial objectives and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. And with that, I will bring in my two guests then. Let's start with Michael. Michael, how are you?
Yeah, hello, mate. Happy Friday. As I said to you just before we hit record, it's been the longest 4-day week ever, I think.
Yes, it's about to get longer with us on the.
Well, I didn't want to go there, but yeah, you're right.
So stay tuned, everyone. And Ryan Littlestone of Forex Analytics, how are you?
Good morning, mate. I'm having a 3-day week and it still feels like a month.
Yeah. Good job. Right. Well, we'll get to the reasons to why it's been such a long week on a shortened Easter weekend. It's really again about the Middle East and the current tentative, we call it tentative, ceasefire that we're all living through at the moment. Just a quick timeline, because it's, as I said, it's been only a week since we had the president of the free world, well, the leader of the free world, come out and threaten to obliterate a whole civilization. Even coming out of my mouth, that still sounds absolutely ridiculous. But we're here to talk about the markets, not the politics as such. And just to sort of to give you a fresh sort of refresher on what we've seen. So this time last week, it was really full-blown aggression. There was lots of chatter, and we've had Pakistan, that arbiter of peace, really offer to try and do that and try and bring about the two sides, bring the sides together, and to convene some sort of ceasefire and truce, which they have to a degree. I think we can all admit that they've done. But in that week, I mean, when did the ceasefire come in? I think the ceasefire came in on was it Tuesday?
Yeah, it was about midnight Tuesday, I think.
Evening US time.
11:31, I can tell you.
There you are.
There we go.
I knew you had it posted on your messenger board.
That's right. And since then, it's held, I'd say, for the most part. But we've still seen missiles on both sides fly. And obviously, the Israelis are still attacking the Lebanon and Hezbollah. So they're in there, and that's contentious in itself. Michael, let's start with you from an analytical point of view. What do you make of what we've seen so far, and how the markets, how have investors taken to what they've seen?
Well, yeah. I mean, clearly good news, I think. I think we're sat here now with a considerably more optimistic approach to what's going on in the Middle East than we would have had, this time last week or a few weeks ago. But I think that is relatively guarded optimism, because although there is this kind of fragile ceasefire in place, there is still clearly a very, very long way to go in terms of achieving a durable peace agreement. You alluded to what's going on between Israel and Lebanon. That's continuing. The negotiating points that at least have been laid forward in public by the US and by the Iranians seem very, very far apart indeed. So it's by no means a given or a certainty that these talks in Pakistan over the weekend yield anything in terms of progress. But I think in terms of the market reaction this week, I mean, the S&P is up by, just shy of 4%. 2%. We're spitting distance away from erasing all of the losses that we've seen since the conflict began at the back end of February. I think that's kind of a combination of ultimately a massive sigh of relief that we've, avoided this potential for huge escalation in terms of strikes on power plants, etc. And also, reflective of how participants who were positioned short have ultimately been squeezed out on the move that we've seen higher. I think for markets to kind of extend those moves, we actually now need to see, firstly, further kind of concrete steps towards a peace agreement being formed. And then also we need to see progress in resumption of some sort of normal commodity flows through the Strait of Hormuz, which is still relatively elusive at this point.
And that's the issue, I guess, is that despite everything that's been achieved, in inverted commas, we're still not seeing free-flowing traffic through the strait. Ryan, from a trader's position, how have you dealt with this week? How much have you dipped your toe in the waters or whatever? And how you set yourself up really heading into another weekend? And I'd say that guardedly, because I've got a piece from, I think it's ING, that says you should measure the everything in weekends rather than weeks. Think weekends rather than weeks. Says the report as I said, from, I think it's ING. I don't know who the author is, so I'd let them know. Sorry, Rabobank. Sorry, it's not Rabobank. The other Dutch one.
Close enough, mate.
They're gonna love me for that one.
You've lost both their business now.
Let's get back to you. How do you position yourself?
Yeah, trading wise, you can't really take a side. You can't really trade the fundamentals at the moment. You just got to sort of go back into headline trading like the good old days of the floor. This week, I did get into some spoos longs because, well, some options, but just because the underlying news was pointing towards saying, despite Trump's big threats, there was moves underneath the surface, releasing of hostages for France and others. The US, I think it was Hezbollah released, or the Houthis released a US reporter they were holding. So little signals there gave indication that something was brewing more than what we've had before. We've obviously had this relief rally purely because the bombs have stopped dropping for now, but we're not out the woods by any way, shape or form, as you've mentioned. You're right about the weekend risk. We've done it every weekend. We've seen a sort of de-risking or squaring up and just everyone taking their chips off the table. Starts on a Thursday sometimes and then through Friday. I think it's a bit different this weekend because we've got this ceasefire and we've got these talks. I think we will maybe see some squaring off, but to a lesser degree. But that being said, there's still big headline risk coming. If the talks fall apart and things turn sour, then we're going to be in for a very hot opening on Sunday night. Otherwise, I think the market is probably just going to tread water. Whether they can get anything concrete done this weekend remains to be seen. We probably the likelihood is that they have, as they would describe it, constructive talks, and talks will continue. And then I think the market just sort of treads water in between the headlines. But the other thing we've got to remember is that there's still, three factions, if you like, in Iran. So who is really in power and what the power plays are going on over there still need to come to the surface. Yes, we've got people speaking to America or speaking via Pakistan, but there's also the hardliners who are not happy with that, and the moderates and the ones in the middle. So that's still got to play out over the days ahead.
I think that's a really good. Sorry, Harry. I think that's a really good point, because you could be in a situation where at some stage the US and whichever part of the Iranian government they're talking to come to some sort of an agreement, but is that agreement actually able to be implemented with the other factions in Iran and also all of the other parties in the Middle East, Hezbollah, Houthis, etc., etc.? It's there are many pieces of this puzzle, and clearly we're moving in the right direction in terms of moving towards de-escalation, but it's definitely not job done, I think.
No. And do you think this is why we're still keeping a volatility premium in the energy markets and the inflation markets at the moment? I mean, yes, we saw that big drop, 13% drop in price of oil in the immediate aftermath of the announcement that there was to be a 2-week ceasefire, but we've seen it creep up since, and I think it sits just below $100 a barrel Brent at the moment, but we are still hovering higher than when the war started itself. Do you think that volatility will remain until we absolutely have some sort of concrete agreement, Michael?
Was that for me? Sorry.
Yeah.
Yeah, I think it will, because obviously, you do have such a huge amount of risk. You've also got the physical market, which just continues to tighten and tighten and tighten. And I'm not going to claim to be an expert in the physical commodity market, but, you look at front Brent, which is for June delivery, and as you say, that was down 15% or so earlier in the week. Dated Brent, which is physical cargoes, barely moved, which kind of tells you how conditions actually are in the market. The other thing to consider kind of longer term is, and a number of clients have asked me this week, are we going to see crude go back to where it was before all this started, when WTI was at $60 a barrel or whatever it was?
Yeah.
And I think the answer to that is probably no, because you've got a longer run risk premium that now needs to be priced in, plus all of the stockpiles that have been drawn down over the last 6 weeks or so to kind of as a stopgap measure while flows have been interrupted, they're going to have to be built back up again at some point. So demand is going to be at a higher level as well. So, it could take quite a long time to fully erase all of the upside that we've seen.
Yeah, and then you've got the infrastructure damage that will need to be rebuilt and replaced and everything else that goes along with that, which will disrupt supply, I guess, for a while to come.
Yeah, absolutely.
I think you've got to take it in stages as well. I mean, the first thing that will unlock a lower oil price is if the ships start moving, and more than the 10 to 15 that Iran said they will allow. If we get full-on transit happening, then you're obviously going to see a reaction in oil markets then. I wouldn't be surprised if we're trading back down in the 80s perhaps. And then we get into the longer term situation, how much is going to need to come back on and how fast it will come back on, and supplies, and as Michael said, refilling storage and everything like that. So yeah, we're still going to get this volatility that's going to react to the headlines, but get the ships moving, get a more solid deal, and then that's probably a bit of a top for oil, and then it will probably just sort of bleed lower over the months ahead.
Just to give you a bit of perspective then, so 15 ships being allowed through roughly per day at the moment. You've got an estimated 800 to 900 vessels are still waiting to exit the strait. And as this Rabobank report says, more fundamentally, the move underscores Iran's effective control over the waterway, a message reinforced by the publication of the 2 safe shipping routes by Iran's Ports and Maritime Organization. So again, yeah, like you say, it's a long-running issue that really won't be solved, even if we do get an agreement. That will just be price action at best.
And of course, the other thing with all of this is, and it's completely understandable and logical why markets have done this and reacted, so positively to the ceasefire that's been agreed. But you've still got 6 weeks, well, I think it's 6 weeks now, effectively, of commodity disruption and higher energy prices that is going to make its way through the entire production chain and the ripple effect of that through the global economy over the next 3 to 6 months. And we still don't know exactly how high inflation is going to go, how much of a drag on growth this is going to be, whether those price pressures are going to prove persistent. There's a lot of questions that are still unanswered that the market's just kind of parking at the moment, and at some point on some day later on we are going to have to come back to all of these kind of thorny issues.
I mean, this is a bigger question, but do you think 6 weeks is enough to have a real impact on maybe mid-term growth prospects and the inflationary outlook? Again, from the central bank perspective, can they not look through a 6 week period and use the T word?
I think they should. I very much think they should, certainly because and I have a feeling Ryan might take a different opinion to this, but certainly when you consider the degree of slack that we see in the labour market, there just doesn't seem to be a risk to me that you have, higher energy prices for that relatively short period of time spilling over into broader inflationary pressures that necessitates a policy response like we saw in 2022. And actually, we have seen the market price price out quite a lot of tightening from G10 central banks this week. We're back to pricing in a modest amount of Fed cuts this year. I think we've got 20 basis points, 25 basis points of BOE tightening in the curve by the end of the year, which I still view as too much, but it's a lot better place than the 90 odd we were at 2 weeks ago.
Okay, yeah,
I'm actually going to, agree with Michael, because I've said this all the way from the start. I said that hikes would be dangerous anyway, because it is an energy shock, and economies aren't in a position that they were back in 2021, 2022 to wear higher prices. So it would actually probably do them good if we get over this and it's just a short blip in inflation. They'd probably do themselves a favour if they actually cut rates once we've got something concrete to say, rather than let what we're going to see over the next couple of months, which is going to be high prices, feed in and then feeding out again slowly. They could do economies a favour, the ECB, the Bank of England, and actually, cut rates 25 pips and say, right, we know we're going to have this inflation blip. It's going to be hard. We're going to make it easier by cutting rates and offsetting that inflation blip. But it's all on the clock. It's still all on the clock. If the thing finishes this weekend and we're done and dusted, fine. You put it in the blip column. The market's going to forget about it 2 weeks later, and everything will get back to normal, and inflation will go up and inflation will come down again. But if it's dragging on this month, next month, then that's going to be where the pain is really going to happen, because that inflation is going to get stuck in and it's going to stay there for much longer. And then the central banks have got their problem where they got caught out in 2022. They're then going to have to be forced to do something, whether it's the right thing or not, to be seen to be doing something.
As you can see, I've got the nice little graphic of a speedometer. Inflation starting to accelerate again. We did see PCE data yesterday. It was a core PCE price index. It was for February, so it is backward looking. But we already saw a firming in prices from the measure that is the Fed uses, which is a little worrying because it was before we got the start of hostilities. Yesterday, it was a core PC price index. It was for February, so it is backward looking. But we already saw a firming in price. Will not take that view, or do you think that because, as Powell said at the last press conference, he thinks the markets maybe be a bit presumptuous. Maybe that was Bailey, just been a bit presumptuous to think that just because they're keeping rates on hold right now, that don't look into the dots and everything else at the moment because it's too volatile. Michael,
the one that worries me is the ECB. Because as you said, we've heard from Fed Chair Powell, who's been saying, we're in wait and see mode. We're very well positioned to just see what's going on. And actually, I would argue that this is a conversation for another time. But actually, Ryan and I were having this chat in his chat room the other day. If there wasn't an Iran war going on, the labour data in the US would probably argue for rate cuts. So the Fed are kind of in this wait and see, stand pat mode. As you said, Governor Bailey of the Bank of England has basically said, markets are getting a little bit ahead of themselves here. And he said that twice, which is quite clearly him trying to hammer home this message as much as he can. The ones that worry me are the ECB, because they're again talking about needing to be vigilant, needing to be agile. You've got some of the hawks like Nagel openly talking about the potential for rate hikes as soon as the April meeting. And that would be, frankly, the very definition of a policy mistake if the ECB were to raise rates. But the fact that their language doesn't seem to have changed at all over the last kind of 3 or 4 weeks, despite what's happened in energy markets, despite the sort of fragile ceasefire that we've had this week, they're still sounding relatively hawkish compared to their G10 peers, which I just can't help but thinking they're going to actually regret that massively if they do end up pulling the trigger.
But
one thing I'd add to that quickly is, and I can't believe I'm going to say this, actually, Lagarde and Bailey have been two of the more sensible heads, because Lagarde, similarly to Bailey, said, we need to look at all factors. It's not just a question of inflation's going up, we're going to hike. She's attentive to the risks that higher inflation could impact the economy in a negative way. And Bailey said exactly the same thing as well, pretty much that, we're not in the same place we were in 2022. where there's slack in the economy. So hiking is going to do more damage than good. So I've actually been singing their praises that they've come out with that. We know the ECB, it's, there's so many of them and they've all got their opinions, they've all got their own countries to look at. I didn't know it was pronounced Nagel. Everyone calls him Nagel. So is that something you learned from your German counterpart, Mike?
Oh, I wonder where that was going.
Well done, Ryan. I like that.
Sounds like someone out of Lord of the Rings.
Yes.
Nagels.
Awesome. That's a lovely reference. You've got to be listening to the episodes previous to understand what that's all about. But just have a little look out at the next ECB press conference and see if I make it.
You've Lord of the Rings.
Yes.
Nagels.
Awesome. That's a lovely reference. You've got to be listening to the week ahead then. And we'll stay with ECB because ECB minutes due next week. Anything particularly revealing, Mike, that you think from there, or this balancing act that Lagarde has to do, and despite again growing concerns around potential hikes, that it'll be a fairly benign affair.
Yeah, I would strongly favour the latter there. I think it very similar framing actually to what we saw in terms of the Fed minutes this week, where there's not really much signal that these sort of accounts can provide. Even at the best of times, central bank meeting minutes are released 3 or 4 weeks after the meeting in question, so a lot can change. I mean, everything has changed effectively since the ECB last met. So yeah, I'd be placing a lot more weight on any comments that we get from policymakers this week, however you want to pronounce their names, and the final inflation data that we get this week as well, just in case there's any revisions there. They will probably be a lot more instructive in terms of the policy outlook than the minutes themselves, I think.
Okay, fair enough. In terms of the minutes then, Ryan, and we got March CPI as well from the Eurozone next week. Again, would you as a trader just look through that and just go, right, well, look, there's a lot of noise right now. I'm not going to pin my flag to any particular mast right now.
Yeah, I think we all know inflation's going up. I'm a bit surprised. I just looked at what we're expecting from the US today, expecting 3.4% for headline CPI.
Oh, yeah, sorry, just to mention, yes, so we're recording this in the morning, Friday morning. We had we had core PCE data from the US yesterday for Feb, but we got March CPI data today out of the US as well. Unusual sort of combination of the two inflation reads. So go on, you were saying.
Yeah, we know inflation's going to go up. If you want to be, a bit nerdy, I'd be a bit worried about how high some of these expectations might be. Yes, fuel prices obviously shot through the roof and things like that. But it might have taken a bit longer for your normal businesses to start raising prices, and things like that. So it might be that we see not as hot a CPI number from the US as expected, and then next month it really kicks in. But that's just being pernickety. But yeah, we know it's happening. What we have to focus on is the core number. Because all the central banks are going to do their accounting smoke and mirrors, where headline CPI isn't going to matter because we know it's going to be volatile, we know it's going up. Yeah. The core is going to be important to see how much of that headline feeds through over the months ahead, and the core probably lags the headline maybe 2-3 months in this day and age. So yeah, we could see the core, the headline jumping up high, but the core not following as fast. And that's the number they'll all tell us about at the next meetings and whatnot. But the Fed said it in their minutes. A lot of members wanting to give a sort of dual message. They see risks to higher inflation and they see risks to lower employment, and they're stuck right bang in the middle. And until that balance swings one way or another, they're going to stay on hold.
Yeah, I've got a City note here that says from Veronica Clark, and she said exactly that, mirrors exactly that. Everyone will be looking at the headline, but you've got to but emphasize that markets will remain focused on underlying core dynamics. She says that core goods prices could be firmer in March compared with recent months, with a 0.27% increase in our forecast. However, this largely reflects a 1.8% rise in used car prices, which have lagged wholesale trends and should begin to catch up. Other goods categories should remain relatively subdued. And then within services, economists expect a further slowdown in shelter cost growth. So, like you say, you strip out the energy, the volatile sectors and food to that end. It may, well, it won't surprise the pros in the game, but may surprise the wider looking audience really. But again, expectations. Go on, you were saying.
Just one last thing. Just in these early stages, probably PPI is more important than CPI, because that's usually where you can see the real first impact coming through.
Sure.
I know this data sort of drops after, but it sort of runs ahead of CPI. So if we get, you know, moderate CPI from the US and then PPI data, you know, shoots up, that'll be an indication of what we're getting in April.
That's a good point. Next week then, in terms of activity, economic activity, we got UK GDP also backward looking, but again, anyone holding that much hope for a pickup in activity with what we know is to come in March and beyond, you know, and potentially beyond with the start of the war? Obviously, this doesn't cover that period. Michael?
Well, I think it's going to just be more of the same in terms of UK CPI. I'm not sure whether we've got a consensus expectation yet, but I can't imagine it's going to be more than a tenth or two in terms of growth on a month-on-month basis. And, you know, that just reaffirms the idea that growth was already very, very anemic. I mean, the economy's basically gone nowhere since summer of last year. And now you've got the downside risk of conflict in the Middle East, higher energy prices and everything that brings with it. So, yeah, certainly not expecting a particularly optimistic message from that GDP report. But at the same time, it's going to be data that really shouldn't be particularly market moving and shouldn't bother the Bank of England much.
No, and obviously, price, we will, for 3 months at least, we'll start seeing lower energy bills, not significantly, but because of the price cap that's been put. So there is due to be a fall in energy utility bills, at least for the UK households. How meaningful that will be in the big scheme of things, I don't think particularly. But you know, anything at the moment, this economy needs something to help give it a bit of a lift, and potentially that's it in the short term. But as I said, we've got Middle East crisis on the doorstep, and therefore that could have a serious knock-on effect to activity and demand, and inflation expectations, which we've discussed a little bit, could be just as damaging, I think, for the UK economy. But so UK GDP for Feb out next week as well. And we also have Bailey speaking. Now, I wouldn't normally put speakers in because we cover it in everything else, but I will put Bailey in, partly because of what we discussed a little while ago. But there aren't a lot of speakers out as yet, and so someone like Bailey will be maybe potentially a bellwether to understand what central banks are thinking post this weekend, and potentially what comes from it, and how the central banks are looking at it. So I added him in there for a note. But also, what we'll be telling, we got Chinese Q1 GDP out next week. Now, we've discussed it on this. How credible can we take the data that we get from them? Ryan, I know you'll probably step in and make a comment, but Mike, you as well. They would have suffered in normal times more than most from the shutting of the Strait of Hormuz. But as we know, some of their ships are getting through, but clearly not enough to power their continued thirst for energy at the moment. What would you look into this Chinese Q1 data? How would you read it at the moment? And would you pay any mind, Mike?
I think that's exactly the signal that the data could provide. You know, usual caveats must apply in terms of taking the whole thing with a humongous pinch of salt. But yeah, you would expect, you know, we know that China is the destination for something stupid like 80 or 90% of Iranian crude exports. So, you know, there is likely to be some degree of read across from the potential negative impact that has had on the Chinese economy through to what we could see elsewhere. I think the other thing, and it's actually all out at the same time, but the industrial production data will also be quite important on that front, because that's March data. So that will just give us a little bit of perhaps a cleaner read on exactly what's going on there.
Well, that's expected to see a 5.5% year-over-year rise. and it's and I've got this is ING. This one they've said moderation in growth is expected. They see China's trade data out on Tuesday, and they expect strong export growth in the first 2 months of the year to moderate in March, and that's the pattern that they will see for this quarterly data appear throughout all the readings they have of Q1 GDP. They're looking for growth to slow to 4.7% annually in the January to March period, down from 5% in Q4. The monthly activity data and 70 city housing prices will be released on Thursday. And then, as you say, industrial production and then retail sales are projected to slow as well to 2.5% annually. Ryan, do you look at much at the Chinese data and use it as any kind of bellwether or canary in the coal mine for your positions and elsewhere?
Yeah, I like to trade the yuan quite a bit because it can be quite a clear trade sometimes, you know, when they allow it to weaken and strengthen and then they apply the brakes. They can be pretty vocal about it, so it gives you some good signals. But, you know, they've been letting the yuan strengthen and they've let it go for quite a long time, probably the longest period where they haven't been talking about it and the speed of it, which is something that Trump wanted as well separately. He wanted to see a stronger yuan. But the data, yeah, I mean, they were showing signs of some improvements. The big issue for them was maybe sinking into a bit of a deflationary period, which they've seemed to have arrested that, and obviously that will get worse with all these higher energy prices. But yeah, the data, you always need to look at it because they are a bit of a bellwether for global growth. You know, if they're doing extremely well, then it translates across to emerging markets, Asia markets, and all the rest. But that will show a bit of a stark difference because, as we know, things are not as great over this side of the world. You know, with economies in the UK and Eurozone all still hugging the 0 point this and 0 point that. So yeah, we'll have to see whether it sparks anything. And if we get some positive numbers, it'll be interesting to see what the yuan does on that as well.
Okay, excellent. We're coming to the end of the episode. I just want to quickly note we do have Hungarian parliamentary elections coming up this weekend on Sunday. It's kind of gone under the radar a little bit, but people will be looking at it. Viktor Orban has been in power for the last 16 years, but in the opinion polls, apparently he's losing out to the opposition, who, by the way, isn't as anti-Orban or the opposite of Orban as people maybe currently think. But I mean, there are murmurings then that Orban could lose his seat, and that could just restructure some of the dynamics on that eastern part of the Eurozone. Have either of you got any commentary on that? Anything you want to say, or is it you're just going to watch and see how that plays out? Ryan, we'll come to you first.
Oh, thanks, mate. Cheers.
That's the biggest sigh of relief I've breathed all week.
No,
Orban is currently blocking 90 billion euros worth of loan packages for Ukraine at the moment as a member of the Euro area. So him out of the way could free up that and get that passage through and take out one of the vociferous, or I don't know how to put it, but
he's a bit of a thorn, isn't he?
He's been a thorn in the side of the Eurozone for a while, hasn't he? On the European Parliament,
exactly, and you know, apparently very close to Putin as well. But I mean, to be honest, I don't know enough about the opposition to know whether they're just the same, more, less, or whatever. But yeah, we'll have to see how it unfolds, and if it does remove that thorn, obviously it makes things easier for the Eurozone to get stuff done. And if not, then they're back in the same court and trying to unlock and wondering how he's going to play off against Putin. Yeah,
I mean, the Peter Magyar is a conservative nationalist, so again, he's not a lefty loony. He's no soft touch, you know what I mean, on that level. So I don't quite know what they're expecting from that. But I guess I'll keep an eye on Mike. Anything to add?
Mate, I wouldn't even be able to tell you where the Hungarian forint is trading, let alone give you any insight on it. So yeah, I think I might swerve that one.
Nice one. And on that bombshell, And on that bombshell, we'll round up and finish the show. But thank you both for your wise words today. Thank you for your input. Thank you to so he just makes me giggle every time. To Mike. Mike, thank you very much on Pepperstone.
Pleasure, mate. Thanks for having us.
And Ryan Littlestone on Forex Analytics.
Thanks, mate. Always a pleasure.
All right, brilliant, guys. We'll put up your links on the site afterwards. Anyone who's missed the start of this can go back and listen on any of the podcast platforms or on the social media platforms that we push this out on. But thank you all for listening. Thank you too for taking part. And listen, guys, have a safe weekend, and we'll see you on the other side.
You too, mate.
You too, mate.
Cheers.